In the 21st century, we've seen two particularly interesting changes beginning to emerge within the insurance industry. The first of these is a recognition of the underinsured around the world, as opposed to necessarily just focusing on people who have substantial amounts of wealth. There's a broad recognition that 80% of the people around the world don't carry any kind of insurance policies whatsoever. And insurance companies, of course, are interested in exploring the possibility of future growth markets. The major concern about trying to insure the world's poor has ultimately come down to a couple of different issues. The first of these is education about how insurance actually works out. For instance, one group of farmers in Ethiopia, when given information about weather insurance, suddenly saw a much greater degree of interest in buying this kind of protection. Whereas originally it had been deemed to be a highly speculative sort of investment with only a 2% uptake, they realized that after having provided this kind of education to farmers, that as many as 36% of them were interested in buying this insurance. Another major problem with trying to bring insurance to some of the world's poorer people is the reliability and costs of local payments, both for collecting premiums and for paying out claims. While digital banking and mobile phone networks do facilitate this in some areas, it remains a challenge for a number of different countries that don't necessarily have the sort of domestic capital that can necessarily fuel investments in these kinds of infrastructure that's required for this type of payment to be able to be both collected and administered to claimants. And thirdly, we have issues of scale. Many of the individuals who are underinsured don't necessarily have a lot of assets. And of course, we also have concerns about identifying individuals in a number of third world countries where documentation around people's identity may be particularly lacking. One of the other big concerns is, of course, that people who have relatively few assets don't need very large insurance policies. And this means that there's very, very little to be gained from the insurance or by the insurance company, who would otherwise only capture a small fraction of the premiums that they charge, with the rest, of course, going to offset any kinds of claims that might be eventually made. And this means, of course, that the fixed costs of underwriting and adjusting often make these types of small contracts inefficient for large insurers and contributing to the lack of insurance among the relatively poor people of the world. So there are a couple of techniques that we've come up with to try to help resolve these issues. And the first of these is the idea of pooled coverage, whereby a pool of small farmers or agriculturalists might take out an insurance policy and then within that particular pool, allocate any sorts of losses that occur. This reduces the costs of adjusting claims made by individual farmers or horticulturalists, and also reduces the underwriting costs associated with an entire pool versus simply assessing the risks associated with individuals. Now, in addition to that, we also see a significant move towards computerization in the insurance industry. So while there are many firms who are struggling to try to find ways to bring insurance to the world's poor, another avenue for development has been to utilize computers even more than they have been up until this point to try to crunch massive amounts of data about the insured that is suddenly become available. So we've seen insurance using the expansion of what's otherwise known as big data, not only in terms of assessing their risks, but also in terms of trying to automate certain kinds of processes, which were seen as being routine within the insurance industry. For instance, today, auto insurance is almost entirely underwritten automatically by computers, and the brokers are rapidly being replaced with comparative price websites that allow people to shop for the lowest car insurance possible, as opposed to going through a broker like they would have in the past. Similarly, life insurance quotes are becoming more and more automated all the time. However, we're likely to see some resistance when it comes to specialty lines like things like directors and officers liability or insurance for shipping specialized cargo. For now, AI hasn't been good enough to really cut into these markets yet, and has largely been focused on automating away standardized risks and simplifying the assessment of risk that is associated with them. But nonetheless, adjusting does continue to become more and more automated as well. For instance, one recently created Takaful system in East Africa actually pays out on a basis of satellite imagery. Rather than looking at individual claims by pastoralists who claim that some of their cows had died as a result of a drought, what they do instead is they take a look at satellite imagery to assess the amount of grass coverage on the savanna. And if the amount of grass coverage declines below a particular threshold, say 85% of the usual coverage, they recognize that this is often associated with drought conditions. And therefore, rather than waiting for reports that there are dead cows as a result of this drought, they simply trigger the payout as soon as satellite imagery determines that there's less than 85% of the regular amount of coverage in fields. So this has, of course, helped to dramatically reduce the cost of insurance because we no longer have to send out an adjuster into rural parts of places like Kenya or Ethiopia to count a number of dead livestock, which traditionally had been a source of a lot of fraud as people simply moved one dead cow from one farm to another, with both of them claiming their insurance. By pooling and automating some of these contracts, we actually find that we're able to deliver on insurance products at a much cheaper price than before, and are helping to be able to bridge some of that gap of insuring the world's poor through the use of automation. But perhaps the most significant firm in the automation realm has been Chinese insurer Ping An. Ping An is today one of the world's largest insurance companies, depending on how you measure it. Recently married the data from its roughly 600 million regular users of its interlocking financial ecosystem to the statistical estimates necessary to try to price various kinds of insurance contracts for them. For instance, Ping An has a consumer credit department, which of course generates data on creditworthiness. It's got an auto financing department, which it cross-sells alongside its auto insurance. And what we find is that the use of computers has literally come to represent every aspect of Ping An's business, whether they're using AIs in interviews to try to identify the traits that are known to be most productive among their salespeople, or they're simply trying to improve people's connection to healthcare through the use of computerized data sets. What we find is that ultimately Ping An has been wildly more successful in leveraging computers and tech than just about any other insurance company in the world. It's worth noting one of the interesting aspects of Ping An's development has been to make its technological tools available to other firms who might otherwise be seen as competitors, effectively inverting the traditional model and turning its fintech revolution into something that other firms can profit from. So the 21st century appears to provide us with a significant ability to improve the functioning of insurance companies. There might not be a lot of revolutions happening in terms of how insurance companies are governed or who the owners of insurance companies are, but certainly the tools that are used for delivering on this ancient piece of finance are going to continue to evolve in the future. And it would be worthwhile for anybody who's hoping to make an impact in the insurance space to ensure that you understand what the state of affairs are in the tech industry as well, because these two industries, finance and tech, appear to be moving ever closer together as we proceed into the future.